Ever heard the story of David and Goliath? The classic tale where a tiny, underestimated underdog faces off against an invincible giant and somehow, against all odds, comes out on top. Forget ancient slingshots and stone-throwing heroes, because in the heart of the 21st century, a new, electrifying version of this battle unfolded. Only this time, the battlefield wasn't a dusty plain, but the unforgiving, high-stakes world of the stock market. The mighty warriors, billion-dollar hedge funds, and the sharpest minds money could buy, against a wild, ragtag group of internet degenerates who hung out on Reddit, armed with nothing but memes, mobile trading apps, and a whole lot of conviction. On one side, you had the titans of Wall Street, suits, skyscrapers, and the kind of money that makes most people dizzy. On the other, everyday people, gamers, students, 9-to-5ers, and self-proclaimed internet jokers, all rallying behind a stock that most experts had written off as dead. The stock? GameStop, a company everyone thought was headed for the scrap heap. What happened next was so explosive, so unprecedented, that it sent shockwaves through the entire financial world. Welcome to Money Talks Daily. Today, we're diving headfirst into the mind-blowing story of GameStop, how a crowd of individual investors on Reddit toppled Wall Street's best and brightest, blowing up billions in the process. This is a story about money, power, memes, and the internet's unstoppable force. It's true, it's wild, and there's a good chance it changed finance forever. But before we get into the chaos, let's rewind the tape and take a closer look at the main character in this story, a company most people had already forgotten. Not too long ago, GameStop was a king, a staple of every shopping mall, the place where gamers flocked for the latest titles, and where you could trade in your old games for a bit of cash or store credit. Every gamer growing up in the 2000s has a GameStop memory, from the rush of picking up a new release to the slightly awkward feeling of getting 50 cents for a stack of used games. For years, GameStop was everywhere. But then, everything changed. Digital downloads exploded. Suddenly, you didn't need to drive to a store for your favorite game. You could buy it online and play instantly. The world's relationship with shopping was shifting too. Amazon, eBay, Steam. Why bother with a brick-and-mortar shop when you could have everything sent straight to your living room? GameStop's once bustling stores started looking emptier by the month. The company's revenues plummeted. Stores closed. The writing was on the wall. GameStop was turning into a relic, a blockbuster video for the digital age, and Wall Street noticed. To the financial experts, GameStop wasn't just a failing business. It was an opportunity, a textbook case for a financial maneuver called short selling. Short selling is a way to profit when a stock goes down, and GameStop looked like the perfect candidate. But what exactly is short selling, and why did it play such a critical role in this saga? Let's break it down. Imagine you think a company is about to tank. Instead of buying the stock, you borrow shares from someone else, let's say at $100 per share. You sell those borrowed shares right away, pocketing the $100. If the stock drops to $10, you can now buy those shares back at the lower price, return them to the original owner, and keep the $90 difference. You made money because you correctly bet the price would fall. But here's the kicker. What if things go the other way? If that $100 stock suddenly surges to $500, you're in big trouble. You still have to buy the shares back to return to the lender, but now it costs you $500, a $400 loss per share. And unlike regular investing, where the most you can lose is what you put in, short selling has theoretically unlimited risk. The higher the stock climbs, the more you bleed. Hedge funds like Melvin Capital and Citadel bet big, really big, against GameStop. They shorted more GameStop shares than even existed, banking on a swift collapse. To them, it seemed like easy money. The company was bleeding, the stores were empty, and the digital revolution was crushing retail. What could possibly go wrong? The answer: the internet. In a corner of Reddit known as r/Wall Street Bets, a wild, irreverent community of individual traders, market jokers, and self-proclaimed apes were watching. These weren't your average investors. They spoke in memes, boasted about diamond hands, refusing to sell no matter what, and had a gleeful disregard for traditional financial wisdom. But they noticed something the hedge funds hadn't. GameStop was one of the most shorted stocks in history. So shorted, in fact, that if enough people started buying and holding, the price could be driven up, forcing the short sellers to buy back shares at higher and higher prices to cover their losses. This is what's known as a short squeeze. The more the price rises, the more desperate short sellers become to close their positions, and the higher the price goes in a vicious, self-feeding loop. The Reddit army smelled blood. What happened next was a frenzy. Thousands, then millions of retail investors piled into GameStop. The stock price started to climb, first slowly, then like a rocket. $10, $20, $50, $100. Wall Street started to panic. The short sellers were underwater, losing billions as they scrambled to buy back shares and stop the bleeding. But the Reddit crowd wasn't budging. "Diamond hands!" they chanted, refusing to sell. GameStop shares became a symbol of rebellion, of defiance, of sticking it to the financial elite. The price soared to nearly $500 per share, an astronomical, almost absurd valuation for a company everyone thought was on its last legs. Hedge funds lost billions. Melvin Capital, the poster child for the short bet, needed a multi-billion-dollar bailout just to survive. Meanwhile, some investors who got in early made life-changing fortunes. Others, who bought near the peak, saw their money vanish just as quickly. The GameStop saga exploded into the headlines. News anchors struggled to keep up. Politicians weighed in. Was this illegal market manipulation, or a grassroots movement giving Wall Street a taste of its own medicine? Trading platforms like Robinhood, which had become the go-to app for retail traders, suddenly halted buying of GameStop and other meme stocks, citing liquidity issues. Outrage erupted. Accusations flew that the system was rigged to protect the rich and powerful whenever the rules of the game no longer suited them. Regulators and lawmakers called for hearings. Executives from Robinhood, Citadel, and Melvin Capital were hauled in front of Congress to explain what happened. The financial world was forced to reckon with a new reality. The internet crowd, empowered by social media and commission-free trading, could move markets in ways never seen before. So, what does it all mean? What are the real lessons from the GameStop saga? First, never underestimate the power of the crowd. In the age of the internet, communities can mobilize at lightning speed, wielding financial firepower that rivals the biggest institutions. The GameStop battle wasn't just about money. It was about sending a message. Ordinary people, when united, have the ability to shake the foundations of power. Second, risk is real, and it doesn't discriminate. Whether you're a billionaire hedge fund manager or a first-time trader with $100 and a Reddit account, markets are unpredictable. The same forces that propelled GameStop to the moon also caused brutal losses for those who bought in too late or failed to manage their risk. Third, the market runs on stories as much as on numbers. The GameStop price wasn't just a reflection of company fundamentals. It was a rallying cry, a meme, a movement. Irrational exuberance, herd mentality, and the viral spread of ideas can drive prices to places that defy logic. And finally, the question of fairness. When Robinhood and other platforms restricted trading, it threw a harsh spotlight on the financial system. Many saw it as proof that the deck is stacked in favor of the wealthy, that when regular people finally start to win, the rules get changed. Others argued that extreme volatility and potential for harm justified the intervention. The truth is probably somewhere in the messy middle, but the episode forced a much-needed conversation about transparency, access, and who really gets to participate in the markets. So where are we now? GameStop's price eventually settled down, but the aftershocks continue to ripple. Some hedge funds retooled their strategies, wary of the new power of online communities. Regulators are still grappling with how to address the risks and opportunities of this new era. And for millions of retail investors, the episode was a crash course in the wild world of finance, full of dizzying highs and gut-wrenching lows. Was it market manipulation or the democratization of finance? a reckless gamble, or a long overdue challenge to Wall Street's dominance? The answer depends on whom you ask. But one thing is for sure, the GameStop story changed the way we think about investing, power, and who really calls the shots in the financial world. So, what's your take? Was this the people's victory? Or did the GameStop mania reveal the dangers of mob mentality and unchecked speculation? Should regulators do more to protect small investors? Or is the chaos just part of the game? Let us know your thoughts in the comments below. And if you found this story as fascinating and as wild as we did, make sure to hit that like button, share this episode with a friend who loves a good money mystery, and subscribe to Money Talks Daily. We're here to break down the biggest stories in finance, uncover the secrets behind the headlines, and help you become smarter with your money, one story at a time. Join us next time as we dive into more epic battles, market mysteries, and the moments that make money talk. And sometimes, scream. Because in the world of finance, every penny truly does have a tale to tell.